I'm Austin Williams, and I'm here today with Justin Gartman. He's a fellow wealth coach here at Better Wealth, and he has a really interesting presentation for us on getting insurance on your kids. I'm excited for this.
Yeah, I know that's a question we get all the time is, can I get insurance on my kids? How does that work? And so today, really going to dive into, well, why would you get life insurance on your kids? Maybe you've never heard of this. Maybe you stumble across this and you're saying, hey, why would someone get life insurance on a kid? So that's the questions that we are going to be here to answer today. Austin, you tell me, is this a question that you get all the time?
Generally, I get asked, like, if people want to know, they don't ask why, they generally ask how much. Right. And if I have to tell people that they can get life insurance on their kids, they might be like, I don't want to do that. Or like, so people are generally, if they know about it, they're like, ooh, how much? And if they don't know about it, they're like, oh, why would I do that? Something like that.
Yeah, definitely something that starts with, hey, what we like to do here is figure out what you want and why. So why are you looking at wanting to get life insurance on your kid? What are the advantages of doing that? So that's what we'll start with today. And so after we start with looking at why you should get life insurance on your kid or why you might want to, then we'll look at the numbers of an example of someone who potentially could get a policy like this or a policy like I know some of our clients have gotten in the past. So be able to look at the numbers as well. So I'll say first reason someone might want to get a life insurance policy on their kid is it's going to lock in low premiums. So first reason is going to have low premiums that are significantly lower than what they may be later on down the road. And it's going to be fixed for the life of that child. So if you start with a 1-year-old, they're going to be paying that same amount of premium to keep that policy in force for their entire life, from 1 all the way to 115 if they make it that long. So that can be a huge advantage.
It's just an uncomfortable topic, like thinking about your kid dying. Like as a father myself, like I don't want to think about any of my kids dying, before their time. But ultimately, most of the people who approach us are like, okay, like I realize that there's a death benefit, but like they're more so like wanting to kind of build this kind of liquid savings asset for their kids that kind of can grow up with them, so to speak.
Yeah, and that's definitely the way to look at it. And the other part is that insurance part, that an advantage of getting it while they're young is, yes, we're not looking at the death benefit right then, but at some point that kid will grow up and be a 20, 30, 40, 50-year-old, and they're probably going to want insurance at that point, or especially if you are already interested in life insurance and see the value, you're going to teach that to them. And so it gives them guaranteed coverage. With first, you already get the policy on them. They're going to have guaranteed coverage for the rest of their life from that policy, as well as we have some options that we can put some riders on the policy that guarantees the ability for them to get, depends on the company and the carrier, but sometimes up to maybe 10 times the face amount they started with, maybe up to $2 million of extra coverage over that life of their policy at certain periods. So would be an advantage where maybe they end up with a health problem where they're not insurable. Well, if we do it and plan for it the right way, we can still guarantee that they can get coverage down the road when they need it the most. The other part, I'll say the fun part, is going to be that cash value accumulation. So that's what we're going to gear the policy towards in most cases. It's going to be, hey, I want to put some money in here. How much is it going to be? How much cash value are they going to have when they're 18, when they're 25, 30, whatever it may be? So policy is going to build up that cash value in a safe and secure way. You're going to have tax deferred growth potential. So you're putting your money in, it's growing uninterrupted, continuing to compound, go up and up and up over the life of the policy, which if you start on a kid, it's going to have 50, 60 years down the road that it's going to continue to compound, and the numbers can be pretty substantial. The other thing is you may be looking at, all right, great. They have cash value. What are they going to use it for? And a couple of examples from clients that we've worked with is one is college tuition. We all know college is expensive. We all know there's other vehicles that you could potentially save for college in, like a 529, different ones. Some people know and want to use life insurance as a way for it to be excluded from financial aid. If your money is in life insurance, it's not counted towards that stuff like that, like a 529 plan may be. I actually recently was setting up a policy for someone. That was the sole reason of them wanting to get a policy, was they wanted to put some money away so they could get better financial aid for their kid to go to college. And that's a big advantage. Austin, is that sometimes the question you've got is like, hey, I want to do something on this and have it for college?
Mm-hmm. Yeah. And I think the idea is that the parents who approach us, they're being really proactive because, for some people, looking to, what will college environment be 20 years in the future? What professions will be needed? What will the college system look like? there's a lot of unknowns. It still seems like doctors, lawyers, there's be some people that they'll still have definitely some kind of like need for a collegiate level sort of experience or pathway. What because if you get a 529 and you put this money into it, if your kid wants to use it on non-education related expenses, there's like a 10% penalty that's imposed on it. Knowing that like, okay, so if you put it in a 529, you get the tax advantages, but you're kind of limiting it. But if you put it in life insurance, you get the tax advantages and you're not limiting it, which is pretty cool. You can still use a life insurance, the cash value for college. Like, you're not excluding it. You're just including more things in case your kid wants to, get into flipping houses or, go to trades, trade school would still be part of education, but, go essentially a different route than like your classic kind of college education. Definitely
more flexibility in that. Now they have changed 529 some where there is more flexibility, can be converted to a Roth, which can be a great thing. So I'm not saying 529s are bad. I know Austin's not either. We're just saying there is another option out there, or two options. You can do both depending on your financial situation. But yeah, the other one is just the advantage of beyond college, of maybe they're in their 20s or 30s and now they have a big lump sum of cash value sitting where it's available to them for perhaps a down payment on a house. They want to get into their first house. They want to be able to make a payment on it. It can be that down payment to help them there. It can also be other expenses. Maybe they want to start a business. Maybe they want to buy a business, do all types of different things like that. Another client example had a guy that he had the ability to be able to help buy out part of a practice that he was in, but the loans didn't work out. And so he was unable to do it and missed an opportunity because he didn't have the ability to get money at that point. Just some things didn't work out and he didn't have the cash on hand to be able to do that. And his sole reason for starting a policy on his son was so that he doesn't have to go down that road. By the time he's in his 30s or 40s, he's going to have hundreds of thousands of dollars of cash value available to him that he can borrow and be able to use with no credit check. None of that stuff can use for whatever he wants, which in this case, best case would be to invest in something like that, start a business, and can be a real advantage to him. I don't know about you, Austin, but in your 20s or 30s, if you had the ability to have access to that of something your parents had started, it would be a pretty big advantage, wouldn't it?
It would have been a huge advantage. Yeah. No diss against my parents, but yeah, that would have been a big advantage for me to use and to essentially invest in some kind of income producing activity. That would have been big.
Yeah. So this gives you the chance to set up something for that kid that gives them an advantage down the road. The other thing is, I know probably one of the biggest things that people say to me all the time when they start a policy with us and learn about life insurance, and it's probably the same for you, is I wish I had known about this sooner. I would have gotten started a long time ago. Well, if you're doing this for your kid, guess what? You're starting it on them as soon as what you possibly can. And so it's going to build up over time and really be sort of the best possibility of what they can have. Other part is, how does it go about? Do they own the policy? Do you own the policy? I know that's a question that comes up a lot. Austin, do you want to dive into a little bit more detail on kind of how the ownership sometimes might work?
Yeah, great question. So at least initially, you're going to own the policy, like the parent. Your kid, they're not yet of age. They can't own this yet. And so at first, you're going to own it, which is also great because you're going to, you're funding it. You have access to the cash value. But, if you get this for your kid, more likely than not, you're not going to be touching the cash value because you're going to be kind of keeping that for them later on. And then once they reach a certain amount of age, it can be slightly different carrier to carrier, but, generally 18, you can then transfer ownership to your child. Now, you don't have to. You can hold on to it for a longer time. You can hold on to it until they're in their 20s. If you want to, make sure that, they're not going to drive the policy into the ground or something like that. But you have the ability to control when you hand over ownership to them. And that's actually a really powerful benefit to this.
Yeah. I was going to say at 18, I don't know about you, but I don't know if I would have been able to handle it and been smart with, hey, a lump sum of money that I have, let's see what we can do with it. Probably wouldn't have been the best time for me. Every situation is different. And so it gives you the control to see and say, hey, all right, they're ready at 18. Let's give it to them. Could be 25, could be later that you're in control of giving over the ownership to them, at which point they would also be the ones responsible for paying for the policy themselves now. So that can also factor into, say, hey, you're 25 now, it's yours. You can choose to pay for it or not. One other advantage is it's going to be flexible. So there's a world where you look at paying just the minimum, not paying the full amount, where we're going to be building up the cash value and everything there. We can drop that down thanks to the flexibility with how we would design something like this.
Let's even just talk about that real quick, that flexibility piece, because something that I have several clients who've gotten policies on their kids. If you look over here on that case study you have on the side, there's the annual premium, which is going in. Now we design policies such that the base, or the amount that's buying permanent death benefit, we shrink that as much as humanly possible. And in this policy, I think it's like $1,700 is the base in this policy. So that hopeful 6,000, that the rest of that, that's about 4,300 is paid up additions that you see here in years 1 through 21. That 1,700 base is buying a significant part of that death benefit. And the neat part is that over time in that dividend column, it starts out with 81 and it gets bigger and bigger and bigger. Your dividends grow. And then in year, it looks like 12, you could get 1,800, a projected 1,883 in dividends. And this cool thing is that means in year 12, when your kid is 17, if you wanted to, you could do this thing called premium offset, where you tell your policy to, hey, that dividend that's buying paid up additions, I want you to actually just buy the base with it. And so there's parents that I've worked with that are really keen on wanting to make sure that by the time they hand over the policy to their kids, the kids can either choose to keep paying into it, or they could, if they don't want to pay into it, they could just turn on premium offset, and the policy is basically on autopilot for the rest of their life. They really want to make sure that their kids have that ability, that they're not shackled with this policy that they can't support when they're 18 or whatever, but instead that they could just kind of make it self-funding.
Yeah, definitely a lot of advantage there to that flexibility. So yeah, that policy you're alluding to. So this would be call her Little Sally. She's 5-year-old, and parents wanted to get a policy on her. Chose a girl. I know Austin has girls. I have mostly girls and one boy in my family. So going with the girl here, 5-year-old, and starting off at $6,000 of premium per year. So in this case, this is designed in a way where the parent was thinking, hey, I am saving right now, want to put aside $500 a month for this kid as savings for them. And I only want to do that much. That's how much I want to do, but I like the option. They have the ability to continue contributing and actually be able to contribute more once they reach a certain age. So this policy is built where it can handle more premium. And we'll talk about why as we get down here. So they start off, contribute $6,000 for the first 13 years. So this kid gets to be 18 years old, and she has right at $100,000 of cash value. So go to college, do different things. That's an option of what could maybe be done. They get to, say, age 25, going to have somewhere around $190,000 of cash value in the policy. Again, depending on, this is based on the non-guaranteed dividends. So could be slightly lower, could be slightly higher, because we are looking at, especially starting young, it's going to be a long time horizon. But the big difference is going to be, hey, we're going to wait till they are 30 years old. So our kind of recommendation here at Better Wealth is, if you can start a policy at around $10,000, maybe in your late 20s, 30s, that's a good place to start. You're going to have all of the advantages and be able to really put some money aside and build up to a good amount of cash value. So this parent, thinking with the future in mind, didn't want them to have to start a new policy. You may be wondering, why not? They could just start a new policy and have all the same benefits. True. But if we look here, we started at $6,000. Our total cash value was $4,600. So it grew our cash value by $4,000 that year. So, as everyone knows who's watching this channel, at first, we're going to have some costs and things associated with that. If we come down here now, they put in $12,000 that year. You see the growth of that policy in that year, it changed by $25,000. So it gets better with time, and they would be able to start with a fully capitalized policy rather than starting over there. If that makes it. Any questions there, Austin? I know that's question you probably get, but do you see the big advantage there? Why a parent might want to do this?
You did that very well. You explained that very well. And you explained that so well. I might actually use that exact line of thinking if I'm ever with another client and they ever ask that question. It's like, okay, yes, in year 1, this is happening, but look, further on, what happens, in year 25 in terms of the dollars you put in, the dollars you get out. I like that. No further questions.
Yeah, it's definitely something, like I said, question people say is, I've worked with 60, 70-year-olds, and they say, man, I wish I would have known about this sooner. I worked with 30-year-olds who say the same thing. Well, this would be, hey, this person did know about it sooner, and they start with a 25-year advantage. starting to be able to contribute $12,000 a year, and then continue to contribute for all the way out to age 60. And you can see the big death benefit that they have. This now 4.5 million when we started off at 700,000. And then also you look at the cash value here, and you're at, hey, getting into your retirement years and have $2.2 million of cash value sitting there. Again, could be lower, could be higher based on the current dividend at this company there. But that's where the advantage is. And I know this is showing best case scenario. You're funding at 6,000 and continually fund at 12,000. Like Austin said earlier, there is the ability to only fund at that minimum $1,700, actually $1,777. So would be very low. So if you're a 60-year-old watching this, or a 50-year-old and you have kids, you know you're not going to be able to get insurance like this where you can continue to just pay $1,700 and have a $4.5 million death benefit that's still going to grow. So it's something that really sets up your kids for the future. You can see the advantages of it there. And it's something, if you're watching this, you probably see the advantages of life insurance and the benefit and value there. And then it's just a matter of making sure your kid has something like that available to them as well.
I think those numbers are just incredible. Like even in year one, no, don't even wait till you're 60. Like year one, you put in 6,000 and you have 737,000 death benefit. Like that's unreal.
Yeah, it's a great thing. And this policy is built with room to grow. Say you're a parent, you're doing well. You're like, hey, my business has grown. I got a raise. I can actually contribute $12,000. You could start that. The flexibility is there where you could start contributing $12,000 to the policy, not have to wait for them to do it down the road. So you see the advantages there. Again, to recap some of the advantages, it's really a matter of, hey, it's going to lock in the low premiums. That's going to be a huge thing. It's going to be guaranteed coverage with the policy they already have. It's permanent coverage. And sometimes we can add on a rider that adds the ability for them to get more coverage. It's really going to give them, I like to say, a flexible financial resource where they can use it for college, down payment on a house, an investment, buying a business, starting a business, any of those things. It's a resource for them to have where they have that cash value sitting there. I know there's disadvantages. You could say, I could earn a better rate of return, perhaps in a 529, or perhaps I'm going to start a Roth with them. I'm not saying those things are bad. I'm saying if you do those things already, because a lot of people we work with, I just worked with a guy, he's already doing those things, wants to have more money for his kids to be able to give them and set them up, and is looking at starting something like this. So it's definitely a good option. And especially with the flexibility that they're going to have, there's not many other assets that you can get that give you all the flexibility and options that we know and love here at BetterWealth. Any other thing to add? Anything that I missed that you think any of the viewers might need to know, Austin?
Something that we've talked about previously before is that you can even add certain riders to these policies that can help your kids in the future. One of these is called like a guaranteed purchase option. So regardless of, if your kid comes down with a medical condition or something that would otherwise make them uninsurable, right now, when you get the policy, you can get like a guaranteed purchase option to where starting at, I think it's age like 22 or something like that. And then for like on like an interval of years until like in their mid 30s, they can get like a guaranteed amount of additional coverage if they want it. And that's great because, if they came down with something that life altering sickness or something and that they wanted more insurance, but they couldn't get it, you had already enshrined that choice for them, essentially in amber at the beginning when this policy was made, and they get to now exercise that every, so often that they want to. So lots of options.
Yeah. That's a huge advantage. And that's something that we can definitely talk, because it's different at the different carriers. And also there's some different things that pros and cons of it, I'd say, to whether you have it on there or you don't. And that's something that I say, talk with the expert today. Give us a call, schedule a call. You'll be able to talk with Austin, me, or anybody else here at BetterWealth. And we can dive into, hey, is this policy right for me? Should I get a policy on my kid? Can I get a policy on my kid? And the answer is more than likely yes. And how much can you do? I say that depends. It really comes down to the amount of coverage that you have is what the kids' policy is going to be based on what we can actually do. So there's a lot of details there that we can dive into that are carrier specific and dependent upon you. So I say get on a call. We can answer all those questions and help out and see if this could be right for you.
Amazing. All right. Thanks so much for bringing this to me, Justin, and to everybody watching this video. I really appreciate it.
Yep.